Welcome back to Investing Talk Podcast. Today, we're taking a closer look at EchoStar Corporation. Now, this is a company with a really fascinating and pretty complex mix of assets. You've got satellite stuff, wireless plans, including this whole 5G push, and of course, the dishy network pay TV side everyone knows. And the materials we've looked over highlight some, frankly, critical recent events. So our goal today is to unpack all the latest financials, the big risks, the potential opportunities, and just figure out what it all means for EchoStar right now. And hey, if you find this analysis valuable, please do hit subscribe, maybe give us a like, and definitely drop a comment with your thoughts. And if you're feeling generous, consider buying us a coffee. It really does help us keep doing these deep dives for you.
It's definitely a multifaceted company. EchoStar, describes itself as providing technology, networking, entertainment, connectivity solutions. It's a broad umbrella. And like you said, that covers satellite comms, their wireless operations, especially building out that new 5G network, the Dish H pay TV service, and also managed network services for businesses. They're really trying to leverage their satellite base and those significant spectrum holdings they have. It's about combining these different tech layers.
Yeah, definitely not your standard simple business model.
Yeah.
So, okay, let's dig into the numbers first. What's the latest financial picture look like, say, from Q1 2025? How is revenue?
Okay, so the latest figures show Q1 2025 revenue at $3.87 billion. Now, that is down from $4.801 billion in Q1 the year before, so about a 3.5% drop year over year. And if you look back over the last couple of years, the trend's been kind of flat, maybe even slightly negative, so there's definitely some pressure on the top line.
Okay, so revenue's contracting a bit. How's that translating down to the bottom line? Are they making money?
Unfortunately, the bottom line looks worse. EchoStar reported a net loss per share of negative $0.71 for Q1 2025.
Oh.
Yeah, and that's a bigger loss compared to the negative $1.40 they posted in Q1 of 24. It was maybe slightly better than some analyst forecasts, which were around negative $1.74, but still, the overall trend is, well, it's worsening profitability.
And with losses like that, the usual price to earnings ratio, that's basically meaningless at this point, isn't it?
That's right. You can't really calculate a meaningful PE with negative earnings per share. And that's, a stark contrast to other profitable companies in related fields where you might see PEs in the, 15 to 25 range. EchoStar just isn't there right now.
Got it. Okay. And what about cash? Profits are one thing, but cash flow is absolutely vital, especially for a company pouring money into building a new network.
Cash flow has definitely been feeling the squeeze. We've seen negative free cash flow numbers reported recently. Looking deeper, the financials show pretty significant negative cash flow from financing activities, something like minus $331 million in recent quarters. And maybe the most concerning bit was the report that their total cash balance dropped by over $1 billion just in Q1.
Over $1 billion down in one quarter. Wow, that's quite a burn rate. Does that impact their return on equity too?
It certainly does. When you've got consistent losses and cash flowing out like that, the return on equity, which, measures how well they're using shareholder money to make profit, is almost certainly negative. And that's another metric where they're lagging behind peers who usually manage positive, even if sometimes small single-digit ROEs. So yeah, the financial snapshot it's challenging. Declining revenue, bigger losses, significant cash burn.
Okay, so that's the financial side, and it sounds pretty tough. But the information we reviewed also suggests it's not all doom and gloom, especially when you look at the operational side of things.
Yeah.
They do have this, as you said, unique mix of assets, satellite, spectrum, services, manufacturing. How does that work as a strength?
That unique asset blend is really their key potential advantage. Having that established satellite footprint, loads of spectrum for wireless, the Dish H TV brand recognition, plus those business services, it lets them try this hybrid approach. They're kind of set up as a challenger in a few different markets, trying to leverage all these pieces against bigger, maybe more focused competitors' strengths. While their satellite coverage is broad Ka-band, Ku-band.
Right.
And they do have some solid international managed network contracts.
Right, knitting together different tech. And you mentioned, despite the financial strain, some of the operational numbers actually look surprisingly okay, maybe even good. What did the data show there?
It's a really interesting contrast, isn't it? Take their traditional pay TV business. The churn rate, customers leaving, was reported at a pretty low 1.36% in Q1.
That is low for pay TV these days.
It really is. The reports suggest it's one of their best churn rates in years, if you exclude the weirdness of the pandemic period. And get this, the average revenue per user, ARPU, in pay TV was actually up 3% year over year.
Huh. So they're holding on to those satellite TV customers and getting a bit more from them. That's better than expected, given the cord-cutting trends.
Yeah.
What about the newer stuff? Wireless, broadband?
On the wireless and broadband side, especially with the new network build, they are actually showing subscriber growth. Q1 saw 150,000 net adds across those services.
150,000 net adds.
Yeah, and the info highlighted a pickup in April, specifically around 88,000 wireless subs added just in that 1 month.
Wow, nearly 90K in a month. For a network that's still being built out, that's quite something. How far along is that build out?
The reports mention they have over 24,000 operational on-air sites now for the new U.S. network. That's a key number related to their build-out requirements for the licenses. Operational meaning they're active, contributing.
Okay.
And on top of that, their enterprise backlog, that's future business revenue, also ticked up about 5% year over year. So if you purely look at customer metrics and network progress, you do see signs of operational momentum in some spots.
Okay, so this is the picture. Really tough financials, revenue slipping, burning cash. But then, pretty decent operational stuff happening underneath. Good customer retention, growth in wireless ads, network getting built. But now we get to the really crucial part, the part that's causing a lot of noise recently. The materials detailed some major events that have just thrown huge wrenches into the works, big headwinds and risks.
Yes, this is really the heart of the current uncertainty around EchoStar. Two major things happened in May 2025, pretty close together. First, around May 12th, news broke that the FCC, the Federal Communications Commission, the regulator for all things radio, TV, satellite, cable, and critically spectrum licenses and build-out rules, is investigating EchoStar.
Investigating what specifically?
Investigating their compliance with the federal requirements for building out that nationwide 5G network.
An FCC investigation into whether they're meeting their build-out targets.
Yeah.
Given how crucial those licenses are, that sounds like a massive dark cloud.
It's a very, very significant issue. And the timing connects directly to the second big piece of news. Just a couple weeks later, around May 30th, EchoStar put out a statement saying they had, quote, elected not to make an interest payment of about $326 million that was due.
They elected not to pay $326 million in interest.
Correct. And crucially, they linked that decision to waiting for potential relief from the FCC related to that network investigation.
Whoa, skipping a huge interest payment and tying it directly to the FCC probe, that screams major financial pressure and raises serious liquidity questions. That's a bold and worrying move for a big company.
It's definitely a major red flag. Choosing to miss an interest payment, even if there's technically a grace period, signals serious financial strain. And it suggests their strategy might be heavily dependent on what the FCC decides. Plus, a move like that could have knock-on effects, making future borrowing harder or more expensive, maybe even triggering default clauses or other issues with their existing debt.
And the materials also mentioned this is already leading to legal trouble, law firms getting involved.
That's right. A few law firms, names like the Schall Law Firm and Pomerantz Law Firm were mentioned, have announced they're launching investigations.
On behalf of investors.
Yes, typically looking into whether the company made proper disclosures to the market about its network progress and compliance before the FCC investigation and the missed payment became public, essentially asking if investors were misled, potential securities law violations. And then, beyond these immediate crises, they still face those broader industry risks, technology shifting to fiber wireless combinations, intense price competition from the big cable and fiber guys. It's a tough environment anyway.
So it's like a perfect storm hitting them, immediate regulatory and financial emergencies piled on top of usual industry challenges. What about the leadership handling this? CEO Erik Carlson was mentioned.
Yeah, Erik Carlson is CEO for both the Dish 8 side and the combined EchoStar entity after the merger. He's generally known for focusing on efficiency. Maybe we see some of that in those operational metrics we talked about. But right now, obviously, leadership is under immense scrutiny. They're facing criticism, given how serious these probes are, and that decision to skip the interest payment. That's a big call.
Understandably. And the market. How did investors react to all this news? The stock price must have taken a beating.
Oh, the reaction was sharp and immediate. That May 12th news about the FCC investigation, the stock dropped around 16.6% in one day. That was about $4.01 per share wiped off.
Ouch.
And then when the missed interest payment news hit around May 30th, bam, another big drop, about 13% just during the trading day.
Steep falls back to back.
Yeah.
And I bet trading volume went wild around those days.
Absolutely. Huge spikes in trading volume. Investors were clearly reacting very quickly to the news and the massive increase in uncertainty. If you look at analyst sentiment based on the reports, it's pretty pretty cautious right now, leaning towards mixed to negative for the near term. A lot of analysts are projecting deeper losses for this fiscal year, 2025, maybe even into 2026, as they factor in the impact of all this.
And what about chatter online? Social media, investor forums? What's the mood there?
Online, there's a lot of anxiety, definitely, and tons of speculation. People are talking about the legal risks from those law firm investigations, obviously speculating about bankruptcy possibilities given the skipped payment, wondering about potential asset sales to raise cash, and just questioning if management can steer the ship through the storm. Of course, you always have to take online chatter with a grain of salt. Lots of rumors fly around, but it reflects the high level of concern. Always best to cross-check with official sources.
For sure. Okay, so that's a mountain of pressure points. Regulatory, financial, legal, market, sentiment. It sounds incredibly challenging, but, even in the toughest spots, sometimes there are ways out, potential catalysts. Did the materials point to anything that could potentially turn this ship around?
Well, the biggest potential game changer, especially short term, would be a positive outcome with the FCC.
Right, the source of the immediate crisis.
Exactly. If the FCC were to grant EchoStar some relief on those build-out deadlines, maybe give them an extension, or work out a clear path to compliance that isn't overly punitive,
Yeah.
that could lift the immediate regulatory cloud, and it might remove the stated reason for deferring that interest payment. So a favorable FCC decision is really pivotal right now.
Okay, so all eyes on the FCC decision. Anything else that could help?
Well, just continuing to execute successfully on the network rollout itself, separate from the regulatory drama, getting more of those on-air sites live, expanding coverage. If they can manage the regulatory side eventually, continued operational progress could strengthen their long-term position and revenue potential.
And are they still managing to launch products amidst all this chaos?
Apparently so. The sources mentioned Boost Mobile, which is one of their brands, just launched its first tablet, the Celero 5G TB, at the beginning of June. So efforts like that, trying to bolster the device lineup and attract customers, are still happening. They need to keep trying to stabilize revenue streams, even with everything else going on.
So the main path forward seems heavily dependent on the regulators, but they're still working on the network and products underneath. How does EchoStar stack up against its competitors? Companies like Viasat, SES, Intelsat, maybe even someone like Lumen Technologies.
Well, many companies in those sectors, especially the satellite operators, have also seen growth slow down a bit as things mature. But generally, peers like Viasat, SES, Intelsat usually show stronger core profitability, positive EPS, positive ROE. EchoStar's current losses and the heavy spending and regulatory issues put them behind on those typical financial health metrics right now.
And that unique EchoStar approach, mixing satellite, wireless, pay TV, is that a strategic advantage, or does it just make things more complicated compared to more focused peers?
It definitely makes them unique, that's for sure. Theoretically, integrating those layers could lead to interesting service bundles or unique coverage, but it also means they're fighting battles on multiple fronts against specialized competitors. You mentioned Viasat. They've got a bigger global presence and are pushing hard into LEO satellites, which is a whole different competitive challenge with lower latency and potentially faster speeds. EchoStar's hybrid model hasn't really shielded them from intense competition or these regulatory hurdles, it seems.
Okay, let's try and wrap this up. Pulling together the financials, the operations, the big risks, the potential catalysts. What's the overall summary or outlook for EchoStar right now, based on everything we've discussed?
Summing it up, EchoStar is clearly in a phase of, well, intense near-term uncertainty. It's almost entirely driven by those unresolved FCC issues about the network build-out and, critically, the very real liquidity concerns highlighted by skipping that huge interest payment. Those external pressures are just dominating the story right now, and you see that reflected in the stock's volatility and the cautious analyst views.
Right, those are the big flashing warning signs. But you also point out that underneath all that, the actual business operations show some surprising resilience.
Correct. Despite the major turbulence at the top, the operational data does show some solid trends. Good customer retention in pay TV, actual subscriber growth in wireless and broadband, and progress being made on building out the network infrastructure.
So, balancing those significant risks against the underlying operational performance, what was the suggested takeaway or recommendation from the materials?
The recommendation provided was essentially hold. The idea is that investors really need to watch for that FCC decision very, very closely. The situation feels almost binary right now. The outcome could either make things much worse financially, or if they get a favorable ruling or some relief, it could significantly improve the outlook and maybe let that operational progress shine through more.
A hold. basically saying, wait and see what the regulators decide because it's such a make-or-break issue. That really highlights the stakes.
Okay, so as you digest all this, here's a final thought for you, the listener, to chew on. Given these incredibly high stakes, the FCC probe, the skipped payment, how does a company with such a unique asset mix balance navigating what look like existential threats while still needing to pour billions into building out a network for the future? And maybe what tough alternative paths might management have to seriously consider if that regulatory relief they seem to be banking on doesn't come through soon? It's walking a very fine line, isn't it? It requires some really tough choices under immense pressure.
Indeed. A lot to think about with EchoStar currently. We really appreciate you sharing the info that let us explore this today. We hope this analysis gives you a clearer picture of the complex situation and the key things to watch.